The broadcast is now starting. All attendees are in listen-only mode.
Hey everybody, can you hear me out there? I know there's only a couple people into the room right now. We're running a little bit late, but just wanted to check in. Make sure I can see everything okay here. All right, looks like it's time to get started here. Let's get this stuff set up to roll. Why is it automatically? It looks like it's recording. All right, ladies and gentlemen, thank you folks for joining me today. My name is Eric Wilkinson, and this is the Roadmap to Trading Options course. We're going to be doing the long put butterfly today. One of the things I mentioned at the beginning of every single webinar, y'all, is watch it again. Why? Because it's going to help sink these concepts into your long-term memory, and therefore you're not going to have to think about it a month down the road. Now, what did he say about, I know there's something odd about the long put butterfly. And if you watch it again relatively soon, you're going to actually remember all of that stuff a little bit longer. So try and watch it again. Maybe it's not just this particular long put butterfly, but maybe one of the other ones that I've done on the long put butterfly, because you guys are asking questions throughout these webinars. You drive the content a lot of times. So sometimes we might talk about a different concept in one of the other webinars, so you feel free to watch one of those as well. All right, so like I said, this is on the long put butterfly, but let's get a couple of things out of the way real quick. First off, my name is Eric Wilkinson. For some of you new folks out there that may or may not recognize me as the Wolfman from mainstream media, where I've talked about the economic data, the geopolitical environment, how that all comes in together to impact the markets with some of my market analysis. I do the same thing for you folks in my daily market commentaries, which is basically where I talk about my trades on every single day that we are trading. So I actually started out trading in college with some money I had earned, and then decided to move to Chicago and jumped into the pits at the floor of the Board of Trade, and been trading my own money ever since for about 27, 28 years now. In that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products and just about all market conditions. So that's a little bit about me. Let's get on with it. The webinar is on the long put butterfly, but please take a moment to put this idea on the shelf. Why? Because what we do on a daily basis isn't going through option strategies and trying to find that strategy, the long put butterfly, to implement into our portfolio. I do suggest trying to make sure that you have several different option strategies in your portfolio. Don't be a one-trick pony. And the reason why is because that helps diversify your portfolio as well and your risks. The one thing with the long put butterfly to keep in mind is we are going to see a lot of the rules getting broken with the long put butterfly. I have specific guidelines in order to find the right strategy for your given assumption, and a lot of that has to do with how volatility is interacting with those options. And with this one, it's a little counterintuitive in a sense because we want high volatility with this and we're collecting a debit, usually, or we're paying a debit, I should say. We want high volatility, we're paying a debit, and usually that's counterintuitive to the way I teach. But I'll explain to you why this one breaks the mold a little bit. Think about it this way, it breaks the mold. It starts out as a caterpillar, turns into a butterfly, but it transforms a little bit, whereas most strategies don't. The butterfly is a little bit of a different beast here. All right, so some of the things we're going to talk about. We're going to talk about a directional assumption. Once we've come up with that directional assumption, however you come up with it, you're going through the charts, you're looking at the candlesticks, maybe you have a Fibonacci support or something like that. Whatever reason you come up with, we're going to talk about finding the right strategy after we have that directional assumption. So we're going to follow that roadmap or that path to finding the right strategy. We'll talk about the destination. What I mean by the destination is our assumption is once we have that assumption, that directional assumption, then we need to look at that underlying that we came up with a directional assumption. With this directional assumption, the long put butterfly, we want a market neutral assumption. So let's just go with that for right now. We've come up with a directional assumption that's market neutral. Now we need to find out if that underlying is good to trade options around. Then what that comes in is volume and open interest. And we'll be talking about how we can discern by just looking at the option montage the volume and open interest on this underlying, or making sure that there is a lot of open interest. Why is that important? Because as traders, in options, it's kind of hard to tell whether or not it's good pricing or bad pricing. We'll talk about all of that through when we're looking at the environment. We'll be able to tell if that pricing is expensive or cheap. And the duration, what's the best duration to implement this strategy around as we're going along? And finally, we're going to talk specific about strike location. Now online, you can find out how to do a long put butterfly, right? That is pretty simple, to be quite honest. But what they don't do is tell you what strikes you need, how much of a collection of credit you need for your risk reward on a strategy like this, because that's important as well. Our risk reward versus what our probabilities of success are very correlated. And we're going to talk about that in detail as well. All right, but a couple of things to get out of the way real quick. We've got our roadmap key. When you're looking at a roadmap, we have to understand what those lines on that piece of paper mean, or on that navigation system. And one of the things that we have on the options montage, which is that page that has all of the different numbers on there. It kind of looks like inside of a fighter jet sometimes. But what I'm going to do for you guys is streamline your process. That's my whole goal here, is to really make these things very simple. When you just glance at it, you automatically know exactly what these little nuances mean. And that's what we'll go over here by talking about the roadmap key. And Delta, when we were on the floor, one of the things we used to say about Delta was, hey, Delta is just data. And I'm only going to talk about one of the specific aspects that delta tells us, but it tells us several different things. Throughout this webinar, I might sprinkle some things in there and talk about it. But for right now, going into this, we want to know what delta and how it affects the options premium in relation to what that underlying is doing. Now, as all of these Greeks were built or conceived, the idea was advancement, right? Moving forward, moving higher, always moving in advance, all right? We're not taking steps back, all right? So the idea is advancement. So with this, in relation to the underlying, the assumption is the stock is moving higher. So when we're looking at the option montage, and it says how is delta is the effect on the premium in relation to the underlying. So with this being said, we're going to say this is XYZ. It doesn't matter what stock it is or ETF, underlying, whatever you want to look at. What we're saying is if this moves up by $1, all right, moves up by $1, so now we're at 149.35. So we've moved up by $1 in the markets. What will then happen to these calls over here is they are going to move up by the corresponding 45 cents. So if we moved up by $1, we would then see these premiums immediately go to 405 and 420 from the bid to the offer, all right? That is that increase in delta to the premiums in relation to the underlying moving up by $1. Now notice over here on the put side, all of the deltas are negative, right? So if the underlying moves higher, then these premiums moves up by $1 would decrease by the corresponding puts, all right? And we're going to be working on the put side today, so we're going to need to keep an eye on this. Now, on the flip side, think about it this way. If we move down by $1, then when we're looking over here at the put side, if we move down by $1, a negative dollar, say a negative dollar plus a negative delta makes that a positive delta to the overall premiums, all right? So if we move down, then our put premiums would start increasing, all right? If we move down by $1, our calls would then become negative, right? So we've got that down, right? Pretty simple. Everything's advancement. If we move higher, calls increase in value, puts decrease in value. If we move lower, the calls decrease in value, the puts increase in value, okay? Now, when we're talking about gamma, gamma simply goes with delta. We can just say it goes with delta. Gamma goes with delta is the easiest way to remember it. We talked about this as being the first dollar. Well, this is dollar number 2. So on the first dollar, we saw that our premiums would increase by this 45 cents. Well, and our bid offer was 405, 420 on the calls. If we were talking about moving up to 150.35, then gamma goes with delta on that dollar, and we would be talking about then 48 cents going into those premiums. So then we would be talking about $4.53 and then $4.68. All right, on that first dollar. Again, if we were moving up by $2, the second dollar, we can see, would only decrease by 35 cents, right? Because if we moved up by $2, the first dollar move, we lost 38 cents. The second dollar move, we have a negative 38 plus a positive 3 makes that 35 cents. I cannot hear any volume. Can anybody else hear any volume? Anybody? If you can't hear me, I guess you can't hear me asking the question. Showing my screen. It says that my people can hear you. We have volume. Okay. Let's see. All right, so one thing to note really quickly, if you guys ever have trouble hearing or something freezes up, it's usually their fault. So make sure that you kind of log off and log back in. All right, Trevor can hear me. I tell him to log off and log back in. That's what I just typed to him. All right, so anyway, so on the if we're moving down, right, that first dollar move in the puts, 38 cents goes in there, so we'd be talking about $3. And if we're talking about a negative dollar move, first dollar move down, let's just talk over here on the put side, all right? First dollar move down, we got a negative dollar. We would have been then seeing our bid go 338, right? And then 348 on a negative move, because that's a positive, right? If we move down by $1, we've got a negative dollar plus a positive delta makes that a positive delta. And then that's what our premiums would look like. On the second dollar move down, if we're talking about a dollar move down still, well, then we would have the gamma add into the delta, right? Because it's a positive delta. We've got 38 plus 3, we've got 41 cents. So the next dollar, second dollar on $2 move, we'd have that gamma go with the delta, and we'd be looking at $3 and what did I say, 41 cents? So 79 and 89, 389. All right, so see how that goes in there? Gamma just goes with delta on the second dollar move. Delta tells us what happens to our premiums on the first dollar. Gamma goes with delta on the second dollar. All right, theta. Simply, theta is our thief. Sometimes you want the thief, sometimes you don't want the thief. Theta is the thief in the night that comes and is going to steal our premiums, all right? Now, when you're buying option premium, you don't really want that. When you're selling options premium, you do. When you're doing the butterfly, oh my gosh, it's the opposite. So any puts, calls on the butterflies. Now, I'm not talking iron butterflies or anything like that, or broken wing butterflies. On the regular butterflies, call butterflies, put butterflies, it's kind of a flip on it. Theta is the thief in the night that comes and impacts our premium. So I'd say if you're buying it, you don't want that thief. Well, the butterfly is a bit of a flip on it. So just always know that the butterflies are opposite of what we would normally think. But anyway, theta is the thief in the night, and you can see that that thief is always negative because we're talking about an advancement. One day goes by, premiums come out. All of these, one day goes by, we would lose that corresponding premium to our strategy. All right. If you're buying it, you want to hold that off. If you're selling it, you usually want to take advantage of it. Today, we'll talk about all the reasons why it breaks the rules. But generally speaking, when we're looking at this, you can't go back in time. So the next day, we're going to lose that theta from all of those premiums. So tomorrow, you would wake up 6 cents cheaper if everything else remained the same. And finally, Vega is one of the most important aspects of finding the right strategy. Vega is volatility across the board. And when we're looking at, the Vega column over here, we know that this is just implied volatility, all right? Vega is implied volatility. And that's what all of these numbers are, is the volatility for the specific month. But when we look down in the column, we can see that volatility, the Vega coefficient, is positive. And when volatility expands, all premiums expand as well. And I'm not talking about the VIX, you guys. I'm talking about implied volatility. And the reason why the VIX talks about the broader market and how that the broader market's affected by the volatility. When we're looking at a specific underlying, we need to look at implied volatility. Why? Because that implied volatility, specifically the number right there, is going to tell us where the premiums are in relation to where they normally are. And what that means is when a 26 for XYZ, 26 for XYZ might be really high. all right? But something for like Tesla or another underlying, that might be super low. So the number itself doesn't really tell us anything. I mean, even if it's 100 implied volatility percent or 100 implied volatility or 1.0 on the charts, that doesn't mean anything unless you can break it down to what the underlying sees that in a range. Because what happens with implied volatility, it has a tendency to stay. Implied volatility will kind of do this. It's not like a chart where it'll always go up. So what we can do is say, you know, implied volatility has a pretty defined range. And when it's right here, we can tell that right now, if it were right in the middle, it would be right in the middle between these two, right? Which would mean that, you know, the premiums are about average. When it's way down here, the premiums are really low. And when it's up here, the premiums are very expensive, all right? Or the most expensive we've seen. So the time to buy is when volatility is low. The time to sell is when volatility is high. Except for with the butterfly. With the butterfly, it's a little bit of a different beast. But generally speaking, if you can remember the rule that when volatility is high, we want to sell premium. When volatility is low, we want to buy premium, except for the butterfly. All right? The butterfly is the big elephant in the room, if you will, for lack of a better correlation. Alexander's late, everybody. He owes everybody a pack of gum. I'm glad you made it, though, Alexander. All right. So the idea here is when we're looking at an option strategy or if we're going on a road trip, one of the first things we discern is where are we going? Well, with the underlying, what we're kind of figuring out is a directional assumption. Bottom line is if we're starting out here and like going here, obviously we want to go somewhere in that route. Outside of here, we do not want. All right. So basically we would want the underlying to kind of stay. We want to, you know, stay in a relatively tight range. We don't want to break out to the upside. We don't want to break out to the downside. We want to stay within a tight range. So when we were looking at this, we have a market neutral assumption and we do not want a big move in either direction. We want this to stay relatively tight to where we currently are. All right. So when we're looking at this strategy, the first thing you would do is you're going through all this stuff. You're kind of like, I don't think this thing's going anywhere. I think we're going to get stuck in the mud here for a little while. Well, that's the time to start thinking about a couple of strategies. One of them would be the, you know, the short straddle, the short strangle, which we've done webinars on those. You know, the iron condor, the iron butterfly, those would be good for high implied volatility, market neutral assumption, right? So that's in the mix. The idea with the butterfly, though, is that it's even you're a little bit more solid, you're more confident on the market neutral assumption. You're trying to tighten it up a little bit more. And what are the benefits of that? You're thinking, well, I got to have a tighter range. Well, yes, you do have to have a tighter range with this one than, say, for instance, maybe the straddle or the strangle. But you're going to be paid off better with this strategy than you would with some of those other ones. You're going to have a higher profit potential than you would with some of those other ones. And you're going to have less risk than you would with the straddle or the strangle because those are unlimited risk. This is going to have a defined risk strategy. Okay. All right. So do we have a good destination? Really what we're trying to talk about is if we were going to go somewhere in here, is there a lot going on? Is there a lot of sights to see? Do we have a lot of open interest when we're looking at this particular underlying? So when I'm saying, do we have a good destination, I am specifically talking about when we come up with a market neutral assumption, I believe that, say for instance, Lululemon's going to be stuck in a range here and kind of ping back and forth. That's what I've come up with how I've come up with my directional assumption. It looks like it's kind of broken out a little bit. I do expect it to come back down in here and just kind of trend sideways. That's what I'm looking for. And if I have to look for a good destination, what I want to know is now, do I have a lot of, here actually, let me, because I noticed earlier today, or right before I went on here, which was one of the reasons why I was a little bit late, was because the markets got really wide after the close. And my rule for this is when we're looking for good volume and open interest, the way to streamline that process is look at the underlying, move the decimal 3 ticks to the left, and we would say this would need to be about 38 cents wide to the bid offer down here on these markets. And you can see it's just slightly outside of that there. We got a bit of a double there. It's right there around 40 cents. That's pretty close. 35 cents. So that's inside that. So normally when I'm talking with this type of setup and we're trying to find whether or not this is a good destination, I would say that this is a yellow light for the most part. This underlying, the way it's set up right now, is yellow light. So if we're going with the correlation to a road trip, we've got the stoplights. If it fits my rule, if it's fitting the rule, I don't know why I started writing that. If it's the rule, it's a green light. 2 times the rule, it's a yellow light. So that's why I'm saying this is a yellow light. It's not fitting exactly inside that green bucket, and 3 times the rule, we don't want to trade it. So like, for instance, in this one, if we were looking at, what did I say, 40 cents. So if it's 80 cents in this regard, it would be about a yellow light. A red light would be $1.20 wide to the bid offers down here, okay? So you can see it's fitting the rule of moving the decimal on any stock that's greater than $100. If it's greater than $100, then we want to move the decimal 3 ticks. You move the decimal. Move 3 ticks to the left, all right? It's greater than $100. And then it should be less than or equal to that move. So let's just say, for instance, if it's a $300 stock, you move the decimal 3 ticks to the left, it should be less than or equal to 30 cents to the bid offers down here. Okay? And you can see right now with our example, it's right around 40 cents. It's a little bit of a, I don't know, maybe a neon green if you mix green and yellow a little bit there. So it's kind of falling somewhere in between here for that Lululemon one. And if it is a stock that is less than $100, then basically we want it to be 10 cents wide or less than 10 cents wide. So when I'm looking at, do we have a good destination? It's not letting me change my thing. When I'm talking about do we have a good destination, we're talking about open interest and stuff like that. So like I said, on a stock over $100, greater than $100, you move the decimal. Move the decimal 3 ticks to the left, all right? If it's less than $100, then basically it needs to be less than or equal to 10 cents wide on that bid offer. That probably wasn't a very good screen to write on. But we'll go over that a little bit more as we go on. I'll make sure I hammer that one home. What's the environment? Well, when I'm talking about environment, we're driving. Well, low volatility is usually when there's no stress. And I kind of correlate that to when it's sunny skies. You just kind of put the top down in the convertible and you take your time getting to your destination, usually meaning you have a longer time to get there. You're looking in the option montage on longer days to expiration, right? And when you have high volatility, you want shorter duration. Now, this is one of the things with the long put butterfly I talked about we're doing it a long put butterfly you do for a debit, but we want high volatility. That breaks the rule there. Here, we do have high, if we have high volatility, we are still going to use that shorter duration, all right? Is this an at the money fly? Yes. So how do we determine if we have high volatility or low volatility? Now, I don't want to scare anybody away right now, but I am going to do a little math here. And that is just for the people that really like to know the devil of the details, really. I'm going to show you guys easier ways to figure this out. But how the number comes up, how we determine whether these premiums are expensive or cheap, or if this underlying has high volatility or low volatility, you have an equation here, and we take the current IV, implied volatility, minus the low volatility, implied volatility, and you take that sum and divide it by the high IV minus the low IV. All right, and really what that does, remember when I was talking about the current IV, it tells us where current IV is when you have the highs and the lows. It tells us where current IV is in relation to the high and the low. All right. So ultimately what we're trying to do is when we're finding all of these points, right, we can kind of eyeball it as well and say, all right, well, that's well up in the upper half. I can just draw the line there and see it, right? So that would be considered more of this is high IV in that case, all right, where it's nearer to the upper band of where we've seen it happening. So that's all we're trying to really determine with this type of underlying. And one of the things that we have going here in Lulu is the fact that, or any market, to be honest, is we have this outside event here, and we've got 2019 still coming into our math, all right? So, or into our equation. And one of the things is I want to discount those. Why? Because I say that this is a black swan event. It's not going to happen for probably 10 years from now, all right? And I don't think that we're going to get down to the kind of volatility we've seen in the past couple of years, right? Because there's still a lot of uncertainty out there. I don't think that there's as much uncertainty as there was at the beginning of the crisis, but there's still uncertainty. So with that being said, I would say that what we would want to do is come in here and say that from here is our what we want to take into account. So we would say that like that's the low, and say for instance this would be the high. So we want to figure out where this mark is in relation to those two dots, if you will. So you can kind of ballpark it. I don't have a line that's going to line it up with the PowerPoint, but you would be able to see that we can. Here, I'm just going to pull up the platform for this and see if I can't. Let's see if I can get over to a chart here. I don't know why you're doing charts like that. For some reason this platform's going wanky on me. Lulu, I want to see what Lulu is and what is the chart of Lulu. I don't know what all this stuff is at the bottom right now. I must have accidentally clicked on something. All right, we'll go this way. Find a chart of Lulu. That's better. All right, so if we can blow this up, you know, what we could do is just kind of draw the line there and say, all right, you know, 66 is the high there. The low here is about 35. You know, that puts that somewhere right around 50 to the upper 50s there. So you can draw a line like that and kind of determine, eyeball it to take this out of the equation, if you will. All right, so you can figure it out that way and kind of ballpark it if you want. But above 50 is high volatility, below 50 is low volatility. And the reason why this is important is because this tells us where the premiums are. When volatility, implied volatility is at 66, we can tell that volatility is at or near the high range. And when volatility is telling us implied volatility is 36, we can say that that is telling us that implied volatility for Lulu is relatively low. And that means that the premiums are super cheap. And that's what we're looking for. If they're super cheap, you want to buy them. If they're super expensive, you want to sell them, right? Right now, we're leaning towards the upper half. But one of the other things we can note here is it looks like volatility is wanting to start coming out. And that's another key. If volatility is start coming out, then you want to take advantage of that contraction in implied volatility. That's how you will make money on it. Why we have to calculate implied volatility percent? Why is that important? Implied volatility is not enough to trade. Okay, great question, and it is confusing. I understand, and I'm glad you brought it up because I'm sure some other people are like, I don't know what the heck he's talking about either. So what I'm saying here, this number 52, all right, for Lulu is probably an implied volatility percent of around, if I take out all of this stuff, right? I could go over here and look at Lulu on the chart over here where I have it on, I have implied volatility and I have the script that goes in here to calculate it. But this Lulu is calculating this as the high and this as the low. All right. So that throws it off because I do not believe we are going to see this kind of implied volatility. If you do, then keep that in the calculation. But I just think that this is a black swan event because last time we saw volatility spike like this pandemic was 1984, you guys. That was the last time. Not even during the last financial crisis did we see implied volatility spike like this. All right. And before that, it was 1929. So is it going to happen again? I don't think so. If you do, then listen, I don't want to change your belief in how you think this whole thing is going to shake out. But I just think that this is a little extreme, and I don't think that we're going to see that again for quite some time. So to answer your question, why is implied volatility important? Well, specifically implied volatility being this number right here isn't. But if I were to go over here and say, let's throw up Tesla. Why don't you let me type in? Why is my computer acting all funny right now? Tesla, what's a 50? Yeah, it did get below 50 last year, but this year, what's the low? 60. So that's why implied volatility is important for each underlying. We have to determine what this number is, 86, which we find in the option montage. And when I say option montage, basically we're talking about the trade window here. Let me delete this out. That's one of my examples. Tesla, we're going to see that it's going to show that 86. So here's that same Vega. I said it was implied volatility, right? 86. We flip over to the charts. I don't want to see that chart anymore. That's driving me nuts. But 86, we saw that's this number right here, implied volatility. I put it on a chart, on every chart, so I can see where it's at. Because 86 tells me, well, if it was up here at 138, that would be expensive premiums for even Tesla. And, down in the 60s, that's cheap premium when you're talking options for Tesla. And that's why we need to know where the current implied volatility is in relation to where this underlying has seen its volatility before. Does that make sense to everybody? This really, all we're trying to do here is figure out are the premiums expensive or are the premiums cheap, right? And we really need to know that because if premiums are cheap, you want to be selling it and then you want to sell premiums down here and see volatility expand. We talked about it earlier on in the roadmap, right? As volatility expands, premiums go up, all right? And if you had sold premium down here then you are going to get hurt. If you, come on, go away. Oh, God. I'm having all kinds of trouble. You see what I'm saying? If you bought premium up here and they were really expensive and you got this volatility coming out, you could have seen the underlying trade in a sideways market like this. Yeah, I know I squeezed it down. Now it looks really flat. But, you know, it didn't go anywhere. But if you had bought, you know, a call or a put and that volatility came out like that and the underlying just traded sideways, you would be losing money. All right. Is there a particular guideline when the IV is below historical IV? All right, Ron, that's a good question. Yes, there is. Usually, when implied volatility is above historical volatility, that usually means they're a little bit more expensive. If it's below historical volatility, that's a cheaper one. So you can throw that up there too. Stay consistent, though. If you're always using historical volatility versus implied volatility in that rule, stick with that. I specifically like to know exactly where premiums are in relation to where they've been in the past, because that tells me, you know, implied volatility is forward looking. Historical volatility is hindsight, which kind of is in the sense of what we're talking about. So I have no problem with that. I used to do that back in the day as well. I've just kind of switched to this. It's a little bit easier. I feel like I can flip through it and get a little bit more minutia, if you will, a little bit more detail on it. But great question. Yes, you can do that. If current implied volatility is above historical, those premiums are expensive. If it's below, generally speaking, they're a little bit cheaper. Okay. All right, so why does volatility matter? It matters a lot because I think I've explained that a little bit, right? It tells us that when volatility expands, our premiums go up. We can look at this as the premiums. They start going up, and when volatility comes out, those premiums like dwindle. So that's why I was saying, you know, when volatility is high, that's when you're thinking you need to start collecting a credit. And when volatility is really low, we need to think we need to be buying something. Well, the butterfly is a little different. It breaks the rules because what we're doing with this strategy, and we talked about a couple of things with volatility, it affects it'll expand faster in those further duration options, but it also will impact the at-the-money options more than the out-of-the-money options, okay? And with a long iron butterfly, we actually are selling the at-the-monies. And those are the ones that are going to be affected by the volatility the most. And if we're selling the ones with the most volatility, then that's what makes this butterfly really an oddball, all right? Even though we're doing it for a debit, we're selling option premium with the ones that are going to be affected the most. Okay, and I'll show you some details when we get into that a little bit further. All right, so when we're looking at this, we've decided we've got a neutral assumption in Lululemon. So we kind of think that we're going to trade in a pretty tight range for Lululemon. Now we need to go down here. We got to figure out where implied volatility is. So let's break that down. One of the things I could do is I showed you if you take this high point and this low point, right, and the current, that gives us an implied volatility percent of about 28. That would lead us to believe volatility is relatively low for this underlying. But I believe all of this stuff is out of the question. I don't even want to see that. I want to look at the data from what we're currently going on. And I believe that we're going to kind of be in this for at least 6 months or so. This type of volatility we've seen across the board for 6 months or so. Now, I'm not looking at a strategy longer than 6 months out almost ever. All right. So that's why this is important to me as well, because I want to know only in the next few months what's going to happen here. So if I were to look at this and really dig into the devil to the details, I would say that this is about, we're going to say the high is 67. We're going to pull out this low, say that's about 36, all right? And we know that the dot right here is 52, all right? So if we take our current, right, current IV minus the low IV, and divide that sum by the high IV minus the low IV. All right. So we know our data points. We've got the currents. I'm going to round it up to 53. 53 minus 36. Take that sum. The high is 67 minus 36. And we come up with 17 over 31, right? Or basically a 54%. So that's above 50. So my rule for high volatility and low volatility, if it is greater than 50, if this number we come up with is greater than 50, that's high. All right. And if it's less than 50, that's low. And that's, you know, if you have a relatively decent risk tolerance, but I have no problem if you guys went and you're brand new to options trading, just say, hey, if it's greater than 75, that's high, and less than, I'm going to say 30. I know that's a little bit off, but let's just say greater than 70, less than 30. You're not going to have very many opportunities above 75. So, you know, you could say that that's going to be your risk parameters when you're first starting out with trading, okay? But this is how I'm going to pound it out. But usually I do it with the cursor where I just kind of go, okay, that looks like it's a little bit closer to the high side, right? You can do that too to streamline your process. But ultimately what we've decided with Lulu is we have high implied volatility. We also know that we have so let's go stepping back. We came up with our directional assumption. First thing we did. Next thing we did was go over to the option montage and moved our decimal 3 ticks to the left and said, all right, in that we have to have 38 cents, right? To the bid offer. We've gotten that checked off. We've gotten our market assumption. We believe this is neutral. All right, so we checked that off. Now we're looking at implied volatility. We know we have high volatility. High IV. All right. By coming up with the math in the implied volatility percent with this one. All right. So now we know we have high volatility. With this strategy, whenever you can know that when you have high volatility, you want the duration to be short. All right. You want to take advantage of volatility crush and streamline getting there. You want to take the direct route. Now, normally I say when buying an option strategy, a trader wants to limit theta decay. Well, it's the butterfly, so it's breaking that rule. All right. Why? Because we're selling at the monies here. So one of the things we want to look at, this theta decay, because it really starts taking off. We don't want to be out here because we want to sell to at the monies, which are really going to be affected by this strategy. And what vehicle are we going to use? We're going to go straight to the long put butterfly. Now, like I said, why the long put butterfly? Sorry, I'm hitting my cursor. Why the long put butterfly? The long put butterfly over, say, a short straddle or short strangle, where we would be looking at the high volatility, taking advantage of a neutral assumption. We are, like I said, with this strategy, if you're picking the long put butterfly, you are more confident of a tighter range than you are. Maybe you're a little bit weary about your market assumption being neutral. So then you would pick the straddle. If you are a little bit less sure of it, then that's where you would go to the strangle and get, because your probabilities of success with the the short strangle are much better. Your probabilities are much better with a short strangle of success, but you're also not going to collect as much of a credit, or you're not going to have a higher max profit, all right, or as high of a max profit. With this one, you're going to have a pretty darn good max profit on it with defined risk, all right? The short straddle, you're going to get a pretty good credit, but you're not having that defined risk. So everything with these strategies is a push and pull on, risk reward as well, all right? So this one has lower risk. Why? Because it's defined risk strategy and the way we build it out. The reward is really good here, but we also need to be very right on our neutral assumption, okay? All right, Trevor's asking, how short of the duration? Anytime I say short duration, if I'm talking short duration, I am talking the sweet spot is less than 45 days. The star of the show is 35 days to expiration. Why? Because that's really where volatility, the theta really starts ramping up. All right. You can see inside of 35 days, you're going to lose half your premiums to 7 days. It feels like it's falling off a cliff there. Out here, it retains that. And if we are selling at the money strikes, we want those things to decay quickly. And we want the volatility to come out because those will be affected more so than the rest of them. And I'll show you that when we look at the platform. So what spots do we visit along the way? Well, we're going to be looking at the long iron butterfly, or the long put butterfly. I hope I changed it over here, and I didn't. This is put. I switched it, and then I went back and started changing everything. So put butterfly. Sorry, this is not the call butterfly. And the spots we're going to pick, the in the money is going to be around the 80 delta. The two short at the monies, these are the same strike. These are going to be the same. And then an out of the money long put, all right, at around the 20 delta. You can look at it like that, the 80, 50, 20. The other thing is we are going to, when we sell these two, what I do is I sell those two first. Whatever collection of credit that is, that's how far out, that's what's going to determine where my longs are, okay? And I'll show you what I mean by that here in our example. The reason why we want really high implied volatility, I want to just show you this really quick because this is an example of Lulu, a good example of how I want to set this up. The two short strikes are right here at the 180. All right, so I sold those two. I'm short two there, and then I'm long the 40s, which is right here. So I bought one, and then out here, I probably should have drawn that sideways. This is where I bought another one, okay? Bought a long and put, short two puts, long and put, all right? Now see how this iceberg is, where we have basically more of the iceberg above the line here. But if I add high volatility, this is what it looks like. It looks like, it's squashed out. High volatility will squish that out. Low volatility, if Lulu had really low volatility, our butterfly would look more like this. All right. Inside of there. And I did it with another stock. It's not Lulu, but I did it with SPY. And following my rules on the debit versus the width of the spread, which we'll talk about here in just a moment. But you can see how much narrow it is. And it's about the same. It's a $10 cheaper stock, but look how much narrower all of this stuff ends up being. It's only, a 20 wide here. And back here, I got it out to a 60 wide. This is $60 wide. Why? Because I'm getting so much premium for selling these 380 puts at the money. These are just 370 puts, basically, right? There's no other explanation other than this has extremely high volatility versus this SPY. So if Lulu had the same volatility, implied volatility as SPY right now, that's what the chart would look like. So something to note with my next rule for the amount we're paying for this versus the width, you can set this strategy up with really low volatility and it will work out, all right, to fit the debit paid versus the width of the spread. But it's going to look like this, and we don't want it to. We want this because now we have a lot more room to be right. I've got all the way down to 340 on this side and all the way up to about, what was that, 118 or something like that. Subtract 40, so yeah, 418 is my break even here. Now look at this on the upside. It's not even above, not even above 380. This one's break even is about 55 or something. So ridiculously tight. Don't have a lot of wiggle room to be right. This one, you got a lot more wiggle room to be right, don't you? All right, so how we set this up? When I'm going through the auction montage with this one, I've got a solid feeling that I'm going to have a pretty tight range. So I sell the two at the monies, right? So I'm going to sell this one. And you can see that if I sold it, I would get $25.70, right? Let's just call it $26. Now, how do I find out where the wings are? It's basically the debit paid. So if I sold, the credit collected. If I sold two of these, I'm talking about $52 wide, right? So if I sold two of them, you can think of 2 times that credits, how far I go out the timeline. Well, this has such high volatility. That's where we start at. You can see I was able to get to 60. All right. What we need here, though, is we want to pay a third the width, ultimately. So 22, and I've got basically $60 wide, or $60 wide. I pay 20, it's $60 wide. That's risking one to make two. That's another way to think about it. Risk one, and however you want to pay a third or risk one, these are the exact same thing. Risk one to make two. $2, all right? So in this case, I'm risking $20 to make $40, right? This is how that works out. And we'll go over the max profit and everything else here in a second. So first thing we do, I'm going to pull up the trading platform, but because the markets are so wide, I don't think it's going to work out with this one now. So we'll go here and look at it as if I were, and it looks like we got a nice, oh, that's Tesla. I want to look at Lulu. All right, so let's expand this out. So for instance, if I was going through this one, I'm going to try and look for that 50 delta. It's not always exactly a 50 delta. You can see here it's 49, but that's as close as we get. So I hit that once, hit it twice. I hold down the control. I build this out myself. So I'm going to change these as well. But you can see I got $26. I've sold it twice. So really my collection is about $52. So first thing I need to do is think $50 to the downside is the 30s. And I would sell that one. And then $50 to the upside is from what I do, the 80s, $50, the upside is 430s, and hit that. Now, what did I do? Oh, sorry, guys. Start over. Sell that twice. $50 to the downside, I need to buy the 330s. $50 to the upside, I need to hit the 430s and buy those. So we've got $50 wide, right? And I've collected $14 and 55 cents. So that's a little bit more than risking 1 to make 2. So that's why I decided to go out a little bit further. So if it's the closer you get to risking 1 to making 1, or a 50-50, then your wings are a little bit too tight. You can string them out just a little bit further. So again, we're going to hit this twice. We know we collected 50. We want to go $60 now. We're going to go to the 320s, and then $60 to the upside is the 440s. And you can see it's right in line with what I was looking at before. So it's close to risking 1 to make 2. Does that make sense? Because I've got $60 wide, which is my defined risk. And our max profit, let's just go over this now real quick. I'll bring this maybe back up. Our max profit is that in the money put minus the at the money put, or basically the base to the wing, all right, which is what we call the, this is a wing, this is a wing, and this is the base, right? So what we're talking about is basically from the base to there, all right, the base to the wing, or the base to the defined risk strategy. So basically it's the base to the wing minus the premium paid. So we're looking at, I think it was $21, right? Let's just say it's $21. And the width here we already determined was 60. So 60 minus 21 gives me 39. All right? You got that? Now, a perfect case scenario would be 20 and 40, right? That's risking 1 to make 2. But we're just a little outside of that. We're kind of ballparking that there. All right, so our max loss, we are paying a debit. It's always the debit paid, no matter what. Yes, butterflies break the rules across the board, but anytime you're paying a debit, you know that that is your risk. So think about this. In this one, our risk is 1/3 of our reward. So you have great upside with this strategy. You're risking less than you're willing to make, but are able to make. But with that, because we're risking so much less, our probabilities start narrowing a little bit, right? I talked about the strangle. Probabilities of success on a strangle are going to be much better, right? But you're also rewarded a lot less. So with this one, we have a huge reward versus our risk, but we have to then, be a little bit more sure of our strategy there. Okay? Does that make sense? How all of those levers and pulleys start working together? That's why I said with this one, we need to be a little bit more confident on our neutral assumption. All right? If you're picking the long put butterfly, you need to make sure you got a pretty tight range. You're closer to nailing the number here. And then finally, on the break-even profit loss stuff, we have 2 break-evens. Why? The market can't go in both directions at the same time. So we have a break-even, our out-of-the-money put plus the premium paid, or our in-the-money put minus the premium paid. And I showed you that on the Analyze tab. We'll pull that back up again and take a look at it here. We'll go over all of this stuff real quick with the platform on that. Let me pull up this real quick. We'll go over this real quick. So if I were to go through this process and I was looking at Lululemon, out this chart, give me a good chart of Lulu. So I'm flipping through the charts and I come across Lulu. First thing I usually would say is, all right, hey, I think it's, it's stuck between these Fibonacci's and I think it's going to stay there for a while, right? It's going to kind of just ping back and forth here and move sideways. I came up with my assumption. I'm pretty solid on that assumption. So now I need to look at the underlying. I go to the underlying and I say, does it fit my rule? Move the decimal 3 ticks to the left 1, 2, 3. I've got about 40 cents or whatever, rounding it. And look to this, the option montage with closest to the 35 days to expiration. Why? That's the spot month. That's where everybody's eyeballs are. That's what the most people are trading. So that's why we're looking as close to 35 days to expiration also as we can. A lot of people like to take advantage of that expiration cycle and get involved. So for this rule, that's what we're looking for to follow that. We already determined we've got a bit of a yellow light here on our strategy, right? Because it's not exactly less than or equal to 40 cents. It's sometimes inside of that 40 cents. Sometimes it's a little bit outside of it. It never really doubles. It definitely never triples on it. So we're going to say it's kind of the yellow light. If it, you get the big red light on this one, I'd say don't trade options around that underlying is what I would default to. And then, so I've gotten all of that. What are the other things we want to look at? We could look at doing the straddle or the strangle and stuff like that, but we've decided we've got a pretty tight move here, and we want to look at the at-the-monies, the 50 delta, sell those twice. Look at my credit here. You can say that. That's how, double that number here. We know we did it twice, so we've got a collection of $52. You can start out going that far away. Another thing you could look at is what I showed you is the 20 and the 80 delta, right? So the 20 and the 80 delta would kind of lead you to that same area of the $50 up, the $50 down. Now with this one, it has a lot of implied volatility. So when I did that, I could see that, hey, you know what? It's not quite, I keep doing that, I don't know why. I go $50 down because I'm thinking it's the next thing to say. $50 up. Doesn't quite fit that rule. It's a little bit expensive for my reward. So that's why I decided to then go a little bit further out. Squeeze, because the further out these wings can go, the better off you are. And the reason why I can get so far away with this strategy and go $60 out to the downside and $60 out to the upside is because I'm getting so much premium for these at the monies. And I told you, I sold these, right? We went through that already. I sold these 380 calls or 380 puts, I'm sorry. And you can see that theta is most aggressive on those as opposed to the ones that I'm buying, right? A lot less than the ones that I'm buying. Well, if I'm selling premium, I want that theta, that thief in the night, to come and steal my premiums, right? That helps me out. Theta is more aggressive the closer we get to expiration. I'm selling the at the monies. That's where theta is the most aggressive. And if we stay right here, he's going to erode those more than the ones that I bought, which is what I want. I want to see that middle shrink and those ones kind of hold on to their value on the outside. If I get those ones to shrink in the middle, I'm going to be able to get out of this strategy for a credit, right? Because those ones that I sold are worth nothing. I'm buying them back for nothing. And the ones that I bought are retaining value. And when I sell out of it, those are the ones where I'm going to capture my premium back, right? So I'm going to be able to buy this for a debit and sell it back for a much larger amount, all right? We can also see if we sold this in high volatility, how much volatility is going to affect these at the monies. It's a lot more than the ones that I bought. So if volatility comes out of this strategy, because I got involved, I was smart enough to get involved in this when it was high volatility, got my wings really wide, increased my probabilities of success. And if we stay right here, following I'm correct on my directional assumption as being market neutral, that theta is going to eat away at those at the money premiums much faster than the ones that I bought. So that works in my favor, all right? Volatility starts coming out, which is what I want. We see that volatility coming out. That's going to affect those at the monies more so than the ones that are out of the money or in the money because they're going to retain that value. All right. Does that make sense to everybody so far? Did I lose anybody here on that concept? That's why this one kind of breaks those rules. I ended up doing a debit, yes. All right. Mostly because the one that I bought here that's deep in the money is a lot. It's expensive, you know, but it is value. All right. There isn't a whole lot of extrinsic value that can come out of those. Those in the monies are going to hold on to the value a lot better than these at the monies. Okay, so we want these to really fall apart, these at the monies. We want volatility to come out to crush that premium. We want the theta to just steal it as fast as he can. All right. While all of these out of the monies and deep in the monies aren't being affected in the same way or as harshly, right? So if those premiums at the money dwindle quickly, that means when I buy this strategy back, I'm buying those back super cheap. And those ones that are further out of the money and deep in the money, those are retaining value. That makes sense for everybody? So that's how this breaks those rules and why it breaks those rules, because of the way that volatility and theta erode these premiums. Okay, so that's what I want to take advantage of. I don't want a movement. I just want it to stay pretty tight in this range. Okay. All right, perfect. All right, let's talk about our exit strategy, because this is something we need to know before we ever get involved in any option strategy, guys. Always know where you are going to exit this strategy. And with this one, we're looking at taking the long put fly, right? Take the long put fly, and we know our strike locations. I can't remember them offhand right now. I think it was the 380 puts. Oops, 380 puts, right? I think it was. And we're selling 2 of the 380 puts. We're buying. I went $60 higher, so there was the one of the. I'm going to put an @ sign in there so it's not at the 440s. Eric, get it together. And then buying one at the 320s. Okay, so that's how we're building the strategy. The winner on this one, we are getting a massive upside. Winner is our max profit, right? No, you guys, with this strategy, it takes a very long, any of the butterflies, I don't care what butterfly it is, iron butterfly or anything, it takes a long time for these strategies to get to max profit. I mean, basically the last day, and you got to, if you wanted max profit, it would have to be $380 and 1 cent to basically get to your max profit. All right. I don't want to deal with that stress. I don't want to be in that at all. So for a winner on this one, I'm looking at basically taking 25 to 30% of max profit. All right. And that's a huge credit. On a loss, newer guys say, hey, on a loss, 50%, 50% less on the debit. All right. So for instance, in ours, we're looking at $20. If it gets down to $10, pull the ripcord on it. I'm going to probably ride this out because the risk reward is so great on this. I'm going to let it test me all the way. All right. And just let it ride out. But that's me. I have a high risk tolerance. If you guys want to look at it like, okay, you know what? I'm going to pull the ripcord. If it decreases by 50%, cover it at 30% of max profit. All right. You know, a lot of times or better, 30% or better. You know, you can get that volatility crush happen right inside that 35 days to expiration. So I have seen this strategy knock it out of the park relatively quickly when you get volatility crush. And that's when that volatility comes out real quick. Pull the ripcord on it. If you've gotten 50% of that max profit, I would run for the hills, right? Because otherwise you're going to be in this strategy until the sun goes down. And that means at expiration. And you don't want to be dealing with this at that point in time, I don't think. All right. So get in and out quickly. So on the long put butterfly, we're looking at 30% of that max profit, which would, in my case, be equivalent to about, what is 30% of 40? So about $12 increase, right? So $12 is where I'd be, you know, I bought it at 21. I did a 21 debit, right? So max profit of $12. I would exit when it was trading around 33. If I could get out for $33, then that's where I'd get out. All right. And one thing to keep in mind, you guys, I know I talk a lot about options and, you know, dollars and cents being, you know, hey, this premium is only $21. Well, I assume the option contract multiplier of 100. Anytime I'm talking about that, 30 cents is $30, right? $1 is $100. $21 is $2,000, okay? Any other questions? All right, I'm throwing you guys a link to the offer right now over there in the chat window. This is what we are going to be looking at for right now. We have the Wolfman's Trading Bundle. I kind of named it that. Basically, you guys are getting instant access to four of the most popular courses we've ever done. And you will basically go from knowing nothing about options to being able to teach me maybe options, or you'll be able to teach anybody and you'll be able to watch TV and be like, you are an idiot. Why are you doing that strategy with high volatility and stuff like that? But instant access to the best content we've got. You'll also be able to spot opportunities and exploit them quickly. We're streamlining that process to take you guys from a novice trader to the guru. All right. So we also have trader hacks. These are great if you want to streamline that process of looking at different aspects of options and option strategies and knowing if it is working out correctly. Also, how volatility works and when to take advantage of it, kind of like what we talked about here, how we're going to take advantage of it, and a ton more. You're going to get that content for no, you know what? I'm going to throw you guys the deal for $497. All right, if you guys take advantage of this today, go ahead and click on that link. You will get all of these courses. So it is, you know, I don't even know how many hours, probably over 50 hours of content here for less than $500. So buy yourself a Christmas present and take advantage of that. Also, I want to thank you guys all for taking advantage of this. If you guys want, there is the course as well. You'll have to pause, punch that into your URL. Thanks for taking advantage of this. 310-598-6677 is how you can get a hold of me. If you guys have any questions, comments, or ideas for future webinars, give us a buzz, or trading@protraderstrategies.com. All right. So take advantage of that. Like I said, the link is in the chat window for you guys to easily click on that and get set up. You know, we have some fun ones in there, some quick ones where you can refresh your memory and take advantage of that. All right, that's all I got for you guys. Other than if you got the cameras up, you can't take that. That wasn't a very good one. If you can't take that, take it easy. Take care, guys. Thank you. Appreciate it. Take care, Alexander. Bye for now. Make sure you take a moment to go over the disclaimer. Know your risk.